Hello, everyone. My name is Brett Noyce, and I will be your moderator facilitator today, filling in for the great Kyle Ellicott, who is one of my all-time favorite moderators. So I'm going to try to fill in his shoes to be nearly as good as he is. We got an exciting topic today where we're going to talk about investing in international companies, which is a very exciting topic near and dear to my heart. A little bit about myself before I hand it over to our guests. Generally, I'm a guest on the show, pretending to know what I'm talking about. But today, I'm going to let the experts talk. As a background, Davis Reed Advisory is we advise funds and family offices on developing pipeline for investing in early stage companies. Previous work, I started and ran an international incubator program based in the Bay, but we worked with companies around the world. Helping them raise their first capital and raise capital specifically from Silicon Valley. And Lewis might get a little kick out of this, as my previous work, what kind of brought me more into the venture space is I worked for Tim Draper, right? So as I looked at your background, it looks like you've spent some time over there learning from Tim Draper. So I'm sure we got some stories we can talk about that. With that said, Lewis, would you introduce yourself and tell us a little bit about yourself and tell us about the Archangels?
Sure. Thanks, Brad. And a pleasure to share this panel with Julio. And I come from Mexico City. I'm based in downtown Mexico City. And for the past 10 years, I've been promoting the local ecosystem and Latin American ecosystem of startups in the super early stages and early stage scene. We've seen massive changes and shifts within the past 5 years in respect of more venture capital deployment, even more startups coming out from throughout the region. And something very important and very interesting is that most of them are not anymore seeking to establish themselves in the Valley, in Silicon Valley, to continue their businesses or raise funds. Because as years pass, there's been much more capital deployment from international-based investors into the Latin region based on the proof of innovation and value of great founders that have proven to become billion-dollar companies and unicorns. So what I do for the past 10 years has been promoting that ecosystem. I started with a small incubator / entrepreneurship club called The Pool, and then that evolved into more of a working chain of office space, of community office space, that gave me that a springboard into venture capital, into traveling around the world, looking and learning from different ecosystems and see what I could bring in back home. And from there, I started a dark fund. I started my Kaufman Fellowship back in 2015, based on the impact that we have done through the pool in helping many startups start up. When there was not many institutions or support in Mexico. And then I evolved into creating Arcangeles.com, which is it's a crowd investing platform. It's in much need in the region in Latin America to give more access and the right to invest any non-accredited and accredited investors to play in this market and in this alternative asset to improve their returns and their yields out of what we see in traditional assets. So my mission is to mobilize capital into visionary entrepreneurs that are solving real problems and helping create abundance and improve the quality of life in Latin America through inclusion of many sectors: financial, educational, health, etc.
Awesome. Julio, on to you. Please introduce yourself and tell us more about your company. Oh, I think you might be on mute.
So sorry about that. Thank you for having me. Great to share the panel. Well, in terms of who I am and what we do, I'm in New York City. I'm based in New York City. I run New York Bay Capital together with a few partners. We started out as a financial advisor, doing M&A for large companies. But several years ago, we decided to venture into venture capital by establishing an investment fund called New York Bay Blue. And so we, as New York Bay Capital, we advise larger companies in their business ventures cross-border activities, mostly between Latin America and the United States. And we have presence in many countries. We have people in Argentina, in Chile, Peru, Ecuador, Colombia, going up, Panama, Mexico, and even Canada. And we're in New York City. But the advisory business is interesting. It tends to focus on large ventures. However, in venture capital, advisory moves a little bit different. I think to participate in venture capital, you have to put your money where your mouth is. You have to be able to invest. Once you invest in a company, you can give them advice, and so that's what we do. We run a fund. We are pretty diversified in terms of venture capital investments. We are in Mexico. We are in a couple of other Latin American countries with VC investments, and also in the U.S. So that's us in a nutshell. And happy to be here. And let's pick a few topics to discuss.
Yeah, well, let's dive a little bit more into that, Julio. So you're based in New York, but you have investments throughout, South and Latin America. How do you vet the companies? How do you come to, I don't know, build the layer of trust with them, and how do you manage the investment from start to finish? I mean, I know that's a lot there, but I think the core question is how do you build that relationship and how do you manage it from afar?
Well, you meet somehow, right? You have to meet entrepreneurs, and it all starts with some kind of an introduction, some kind of maybe meeting at a conference like this, word of mouth. But at some point, you meet the person or the team that's behind an interesting company, and you got to get to know the team. It takes some time to know a team. Experience guides you in terms of what kind of people you believe can run a company. There's no good rules of thumb. There are more exceptions to the rules of thumb than the rules of thumb. People can say that you need to have a lot of experience. We have found a lot of people who have experience that don't actually run companies well, and then we have people with no experience who actually do. So with all this, sorry about that. With all this, what we could do is conclude that it's about meeting and chemistry with the team, and it's about developing that trust. Because the second leg of any good investment is transparency, right? It's especially in the foreign markets. We're not the sole investors in deals. We tend to line up groups where we will come in, but we will invite some friends. We will invite other people, clients in other ventures, people we know, to try and form a bit of a quorum to back a company. And so it's very important for the company to be very transparent, to be very straightforward with the information, especially during the pandemic. As you know, travel has been difficult, and we've actually closed deals without having a meeting with people. But of course, there's Zoom, and there are, technology like the one we're enjoying right now. And so that way you can meet people, even if you've never actually shaken their hand. And but
do you feel that you can still build the same
share information? Sorry.
Yeah. Do you think you can still build the same layer of trust just through a Zoom meeting as you would be? And prior to the pandemic, would you meet them in person, or were you doing it all via video conference?
No, prior to the pandemic, everything was in person. And in fact, if we had been having this conference 2 years ago, I would be telling you that we would never invest in a company without, unless you actually met the people, shook their hand, had dinner, all of those typical important ways to get to know people, especially in places like Latin America, where the social aspects are really quite important. You want to know who comes from what family, who's related to whom, who's friends with whom, what are the circles of the people. But amazingly, I think that we weren't about to just shut down and cease operations until the pandemic resolved itself, because we would have done nothing for over the last 18 months or at least 12 months. But so yes, we are able to invest in interesting companies on the basis of Zoom. Now, of course, the dynamic is still the same. You have to have long Zoom conferences. you have to have recommendations, right? You have to have people who know people and who say, look, I've known so and so for a long time. You can trust them, you can trust her, etc. But so we've been able to make do. I think the pandemic, in a way, it has made it easier, but in a way, it's also made it more difficult to invest. The pandemic has made it so that you can meet more people more easily.
Yep.
And you can spend more time talking to them via Zoom, and you can have we can have a conference call at 1 o'clock, and another one at 2 o'clock, and another one at 3 o'clock, and you can have 10 meetings in one day without having to worry about catching a cab or catching a plane. So from that point of view, it's made it easier, but it's also made it more difficult, because the idea of really developing that trust is more challenging.
Yes, and I think I totally had the same experience. Last year, we moved from incubator to a syndicate model, and we could see. I mean, we went through thousands of companies and just saw tons of deal flow that we couldn't have got to otherwise, where we would have been at demo days or would have had to travel, or people would have had to travel to us, and it made it more accessible. And it was great. We put together. We could find tons of deals and got access to deals that we probably wouldn't have got to otherwise. But the challenge that we really had was, once it came to like actually pooling angel investors and getting them to write checks, it really fell apart for us. And I think if we had already, for our challenge was kind of the opposite of, or the same as most entrepreneurs, like we just hadn't already built those relationships out well enough. So when we brought deals to these different VCs or different angels, they were kind of like, who are you? We want to get to know you first, and then we'll consider your deal flow. And it was challenging. We kind of got overflowed with, there was almost too many companies and too many meetings, and not enough, for our particular case, not enough capital to deploy. But that was ours. I'd like to turn it over to Louis. So talk to us a little bit more about like how you guys are finding companies and how you guys are building relationships.
Well, for us, being maybe more with boots on the ground, as different from Julio, that is based in New York, maybe, and that's on to understand more on Julio's thesis on which stage does he invest. But for us, being with boots on the ground, solid boots on the ground, our referral system within our own portfolio has been very active and very successful in referring us early on rising startups. So that comes from a warm intro. That comes from our own circle of trust that we have built in the past, recommending us a new founder. So it's easier for us to really engage through a Zoom call, or Zoom investing, as they call it. But in a way, since we're based in Mexico and we have been focusing in Latin America as a region, as a unified region, and most of the startups are looking towards Mexico as their destination for expansion after they validate in their local cities or countries, we didn't have much choice before pre-COVID. We did a lot of Zoom calls, and we had to develop this judgment through the internet and through referrals and having several conversations and some teenies, if you want to call it, instead of going for a beer on a traditional bar, which what Julio says is very true. We're very social, and we like to engage with people in a social way and in a fun way. So it's been hard, but it's not impossible. And so our source of deal flow has been from also my past engagement with most of the incubators and acceleration programs throughout the region, and being friends with the managing partners or the responsible behind those acceleration programs. So that relationship that I have been building for the past 10 years has nurtured me with access, very strong access to every batch in a preemptive way. So I can get early before demo days and get to know them before, and at least have 4 months or 3 months before demo day to see how they engage from the point where they started to the point to demo day. So that gives me a broad perspective to make a more intelligent decision of saying, hey, these guys are really executing, and that builds trust on the results that they promise.
Excellent. So I know we have an international audience here, and I know that I'm based in the US, and we've looked at companies, kind of throughout the world. So kind of a jump ball question, kind of hand it over to both of you guys to respond. But what advice would you give to an early stage investor or somebody who wants to invest, in international or emerging market projects? What do they need? Like, what do they need to know to even get started, right? What are the big pitfalls?
If I may, Luis, well, look, I'm wearing a T-shirt here. I mean, if we're going to be open minds, right? Open Mind Social Club. Now, because that's the advice I give to investors and to entrepreneurs, to have an open mind. You may not know how fundraising works. Don't assume you know how it works. Just meet people, talk to people, use your network, and eventually, if you have a good idea, the system will respond for you. But it could respond in many different ways. You might think that you're going to go out and raise equity, but you might find someone who would rather lend you money. You may think that you're going to go get debt, and you'll find that people will never lend you money, but they will invest in your equity, right? You may think that you know your valuation, but you probably don't know your valuation, because the valuation is set by the person who writes the check, by and large. So don't go out saying, I'm worth this much, I'm going to do this, I'm going to talk to so-and-so, I'm only going to go to Silicon Valley, I'm only, it's Sequoia or bust. I mean, it's a process where you learn, and where the investor also learns, and where the first meeting doesn't necessarily set the stage for what is actually going to happen. Sometimes investors will tell you they're interested, but they won't get back to you quickly. Don't get discouraged by that. In fact, investors use time as a due diligence tool, and they don't always admit it. But when you tell someone you're not interested now, it doesn't mean you're not interested a month from now, or 3 months from now, or 6 months from now. You want to stay in touch with them because they want to see your progress. It's very powerful to meet an investor a year later who has done everything he said or she said they would do. And then they come back a year later and they say, look, by the way, this is what we've done. And all of a sudden your perspective on them changes because they've built credibility. That's generally my attitude. There are also new pools of investment. Venture capital is very interesting. There isn't one single traditional, infrastructure for it. You've got now angels all over the place. Angels may not be the most experienced investors ever either. They simply may be people who have some money, but they're excited by the idea of helping another company, but they've never invested.
What would be your one piece of advice for a first-time angel, especially if they were going to invest in an emerging market company?
Oh, wow.
I know.
Be prepared to lose the entirety of your capital.
That is a great response.
And have the philosophy that unless you invest in 10 different things, in order to hit one home run, you need to probably strike out several times. If you think that you've got the one investment and you're just going to do that and you're going to sit back and enjoy the show and be rich, no, it's not going to happen. You really have to suffer early on, learning pains. So try to talk to people who've done it before and who aren't yet discouraged, and then build your portfolio that way.
Perfect.
I can say something there.
Yeah, so I'm going to segue over to this on the angel side here.
So I'll say I summarize it like in 3 words, which is, first of all, you need a good digestion of risk, understanding what it's coming, a good discipline of diversifying a portfolio, a broader portfolio, just to get into the one-hit wonders and then the home runs, because you will lose in most of your investment. You will lose most of your money. So if you don't want to go to you don't want to go back to your house with a bad taste, you need to diversify. And the third word is patience, because returns will come after 5 years. You need to let those companies nurture themselves. That's why it's called seed capital, because you're seeding, and then you have to flower them and give them water in order to grow, right? And that's where additional capital comes in. And the second advice on it is don't fall on the shiny object syndrome. So you don't have to invest in the first company that comes through your door. Be selective and start investing either on things that you don't know anything about it, but then that's the reason you invest, is to learn more about the industry, or invest in companies that you know you could add value pretty much in line with what you invest early on. So say you're investing a 25K check, an acid test, a quick check of saying, how can I add value to them is, on this industry, do I have the means to connect them on my network to provoke meetings that could potentially translate into 250K, 10x my investment in sales. If I can do that, then could be a good investment for you. Then you're de-risking your investment through the network and through the leverage that you can bring in early on, right? So don't go to the flashy object, because everyone is trained, or most of the entrepreneurs are trained to pitch. They're looking to pitch, and they're looking for you to fall in love. So they're amazing salespeople. So you have to read between the lines, and don't fall into the shiny object syndrome.
A good entrepreneur is a good liar, whether they're conscious of it or not, right? So you kind of have to play the game, and you have to be putting out the rosiest version of what you're doing and what you're building. So, and from an investor standpoint, right, you got to be able to kind of sift through what's real and what's fantasy. Yeah. So what was I going to say?
I mean, if I may interject, right now we're looking for the first time at an investment in space. Not the investment in space, but in a company that does business, with in the space industry. We're doing it because we want to learn about space.
Okay.
I mean, we're not necessarily thinking that we're going to be very successful. It looks like we could be, because the returns seem very interesting, but competition is building up. This idea of sending constellations of satellites.
Like, why has space become kind of a hot? Because I remember probably 5+ years ago, I heard people starting to talk about investing in space, and it's probably Elon Musk related or something. But why is this becoming a real investment category?
Well, because it's become cheap with these satellite constellations, right? I mean, to launch a satellite, and it's interesting because as I told you, in our firm, we do a M&A and financial advisory, and for example, we advised Eutelsat, which is a huge European company, in its acquisition of a company called Satmex in Mexico, which happened about 10 years ago. And they bought Satmex, and it was a $1.2 billion or $1.3 billion transaction. And if you were in the satellite business back then, that's not venture capital. That's mega millions, right?
Yeah.
Today, the capacity that one satellite that costs you $100 million to launch or more can be duplicated with a small constellation of satellites that are not bigger than a loaf of bread, and they're you can send them up a lot cheaper because they weigh a lot less. They all communicate with each other. They cover a much larger span of space, and so it becomes very efficient to do internet communications and phone communications through these types of satellites. And they also take pictures a lot cheaper. You can probably guess that cameras have become cheap. Chips have become cheap. So all of a sudden, a venture capitalist can really think about that industry without having to invest hundreds of millions of dollars. I mean, I think that's the reason. But it's risky for many reasons. I mean, one of them is the rockets can still explode. the deployment of the satellites can still fail,
And
and they're not tested over a long period of time.
very different investment versus, investing in software, right? So it seems like the
Yeah.
scalability, physical products, like they're
Yeah.
like also the very unknown of sending something up into outer space and hoping it works. And so I imagine the risk profile in my mind seems just so much exponentially higher than investing in even like like if I'm going to choose between for myself, do I invest in a space company, that I know nothing about, or do I invest in a company that's doing something in an emerging market, doing software and doing some sort of business that I understand fundamentally but don't understand the market? I would probably pick the emerging market, but I also have more experience in that space. So I commend you on like just you guys' approach to just saying, hey, we're going to dabble in this, we're going to learn, we're going to use this investment as the way to educate ourselves.
Right.
I mean, I feel like that's great for you, your LPs, and the entrepreneurs that get to be part of that. Switching over to Lewis here. Earlier, you said you guys are investing in entrepreneurs that are solving real problems. So help us understand some of like the exciting ideas and real problems that the entrepreneurs that you're working with are solving.
So in the first place, I can talk for something more broader, something more common. There's the race of the neobanks and challenger banks in the fintech scene. There's still a lot of innovation and disruption that can be taken away from the oligopolies that we have in the whole region. I mean, just to put in perspective, asset management in Latin America is controlled by only 50 firms around Latin America. In the US, you have, 4,000, 5,000, 10,000 asset management firms, independent, consolidated, all sorts. You have 30% of the people invest in the stock exchange. In Mexico, before last year, we had less than 3% of the population investing in the stock exchange. So that's a lack of access, and investments have been seen as a privilege, not a right. So people will need it to save first in order to invest later, and it could take a lifetime to save in order to invest. And now with fintech, you're giving that abundance and access to anybody to be able to put their money to work harder than the traditional banks offer, with better yields at a less cost. So that really is helping improve your wealth through time, improving your quality of life. Then you have the edtech scene. And well, in fintech, we have invested in, 15% or 20% of our portfolio is distributed in fintech. Then we have a rising community of founders that are pushing hard in the edtech scene. Why? Because again, the pandemic accelerated that adoption, sensibilized most of the young parents around, now I have my kids at home. It's homeschooling. Now I'm being the professor. I'm paying school so they can keep their place for whenever they open back. But I'm the teacher, and I'm paying to be the teacher instead of receiving payment for the teacher. So then that paradigm of saying you have to take your kids to school, and now new platforms helping you leverage that burden of becoming the teacher of your own kids. Besides being an educator of your kids in terms of values and other stuff. So education has risen as well. And also there's a huge lack of access to high-end education. And now online, you can get a better training in order to professionally in retraining yourself. So we're seeing several companies launching their services of retraining people that are already obsolete on a digital market, on a digital environment, a digital economy. And that helps a lot of companies to improve their profitability, their performance, at the same time that increasing the soft skills of their current human capital, rather than looking to replace that human capital, which is much more costly. So that creates impact as well on the economic and also younger and older generations in reactivating themselves and getting prepared for a digital economy. And on the other scene, it's the health tech scene that also has been rising fast, where you also have basically a monopoly in Latin America. Well, basically in Mexico, you have a monopoly, which is a public service, which everybody has to be part of it. You cannot jump out of it. Less than 5% of the population has access to buy a life insurance policy. So, and maybe 30% of the population have car insurance policies. So there's a huge untapped, underserved market that is not included.
So what inhibits people from getting life insurance in your market?
Cost, and also the reach of the traditional companies selling towards the high-end, high-margin market, right? It's a regulated market. There's no sophistication in digital transformation. They don't have automated processes, so they're very obsolete in their incumbent. I mean, they have a lot of legacy systems, and it's very difficult for them to engage to the general public through the internet. They have not been prepared for the past 5 to 10 years. That I mean, you have 90% penetration on the internet in Mexico. You have also 80% smartphones, 80 million, 85 million smartphones circulating in the country. So you have access to the people, but they don't have the means to get that. They have not paved that road. So there's many people that are neglected of it. And finally, we have invested in several companies that are not seeking to centralize their services. Maybe their operations, yes, because of the human talent that you can reach in centralized cities like Monterrey, Guadalajara, and Mexico City, or Bogota, Medellin, Santiago, Sao Paulo, and Buenos Aires, for example. You have much more talent there in humans. So you can base your operations there. But the deployment of the service should be outside of those cities that are very, I mean, your CAC is very high, the cost of acquisition. And the impact, I mean, and the competition is very aggressive. There's a lot of bloodshed within it. So we've invested in companies that have that vision of decentralizing this region, which is centralized in megalopolis, in mega cities, because there's more than 15,000 cities in Latin America with an average of 500,000 inhabitants and less they have cell phones, they're middle class, they have the means, they have the demand, but they don't have the access to have the service in place.
Perception that oftentimes when people think about emerging markets, they just kind of think of people like maybe in Africa in huts, and they don't realize that much of the world is, they have cell phones, they're middle class, it's just a different economy. And I feel like there's a misconception of these markets and a misunderstanding and lack of education.
But they're tech neglected cities. So the services is not getting there. The Rappis of this world, the Ubers of this world are not established in these micro cities or tertiary cities in the region. So we've invested in companies in mobility, companies in super apps, in fintech that are really looking to engage and make the go-to-market strategies outside of the main cities in Latin America, because it could be maybe it seems like it's harder to pave that road, but I think it's counterbalanced when you have millions of people.
Yeah, I think that's another part that people don't really think about is the size of these markets, right? So generally when you're thinking about angel investing, venture, it's always about, how many users, right? Could it be $1 billion company, right? And I don't think people are fully understanding the size, like especially like Mexico City and some of these international cities are just massive. They're almost, the size of like Mexico City is almost 1/3 the size of America, right? So, and yet we're scared to invest in that market because we don't understand it, right? So I feel like there's massive opportunity that I think there's just, that'll hopefully be tapped in the upcoming years. And it looks like you guys will be two of the guys that are leading that. I know that we're kind of running up on time here. So is there any final thoughts that you want to leave the audience with, both on the entrepreneur side and the investor side? And then tell us where you can be reached. We'll start with Julio here.
Well, then let's start where I can be reached. Julio at nybaycapital.com is my email, and I'm also on LinkedIn. You just have to add my middle initial because there are many Julio Marquezes I have found in the world. So Julio A. Marquez will get you to me or Julio Marquez, New York Bay Capital, or some kind of combination of those terms. Last words. It does pay to study and learn and realize. I think anybody who studies these markets, studies, like you said, the size of Mexico, studies the sophistication of Bogota, realizes that there are whole areas of population that are kind of being left behind certain things, but they can leapfrog, right? No, it was very difficult to get a land phone in many Latin American countries. As soon as cell phones were deployed, everybody got a cell phone. So the country overcame the lack of infrastructure through technology. If cities that don't have a whole lot of population start getting their internet from space, well, then you don't have to worry about the local infrastructure, and you will conclude that you have very good opportunities. And so, we've spent, Luis, a few years, and I've spent many years more, always promoting the idea in the United States of investing in emerging markets, whether it's Latin America, India, Africa. We actually do cover some of those markets too.
I want to ask one real quick question.
There's opportunity.
How is your guys' fund structured? I mean, how are you taking on LPs? Is there opportunity for people if they really want to get involved with New York Bay Capital as you as their advisor or fund manager?
Right now, we're only on a deal-by-deal basis in terms of we did not set up a fund with LP structures.
Okay.
I worked in private equity for over 10 years of my life. I understand the private equity model. I just felt like when you're attacking venture capital, sometimes those types of structures are not the most flexible. And we prefer to look at the deals and then invite people to those deals depending on the people's value added. Luis made some comments to that effect. It's important to deal with people where you feel they can add something. I think a small company is too small to have to deal with all of those investors that are not value added.
Yep.
When you're public, you can have all the investors you want that are not value added. In fact, you prefer passive investors, right? That's what everybody wants. But when you're a young company, it takes so much time to take care of the needs of investors in information, in reporting, in just keeping up, that if those investors are not value added, you probably don't want them, especially if you can get a value added investor.
100%.
So our fund is one where if people want to invest with us, we just have to have a conversation, and we have a bunch of deals. We have some portfolio companies that may be looking for additional capital, and so we can facilitate that, but we'll treat you as an investor on a deal by deal basis. Okay. And it has pluses and minuses, but I think that's the nature of
I think
capital in the early stages.
I think that is the future of VC, but that's for another day. We can dive into that on another day. Luis, why don't you finish this off?
Sure. So thanks. And you can reach me at luis@arcangeles.com. That's my email. There's there's Twitter, and you can find me with my name on different social media. And regarding on our structure and how we can advise, I mean, we work with local family offices, and part of our mission and part of our thesis is that wealth transition within those family offices. Currently from the region, and we're looking to expand as well, because we can help them. What we have proven right and we have done is we have two types of vehicles. The first one is, yes, it's sort of a closed-ended fund. It started sort of as a learn by invest approach, but looking to bringing and engage into the inheritors of that wealth transfer, which is more than $260 trillion is getting transferred from the baby boomers towards younger generations in liquid assets. So we have managed to bring in a hybrid model. We have the closed vehicle, small funds in order to build portfolios, but giving all the provider rights towards our own LP so they can double down on each deal on a deal by deal basis, structured in escrows, creating those SPVs So we can also protect the founders cap table. And in a way, you can engage whenever you want, whenever, as Julio said, whenever you want to add value. Now, the Arcangeles.com platform is a deal-by-deal basis approach as well. There's no limit in how much you can invest, and you can select your own deals. We do this diligence as a service that we publish the investment memos on how you will invest, similar to what Republic does in New York, based out in New York. But the value of investing through that, which could be passive investment in most of the cases, it helps specifically consumer products to get to the audience and bring loyalty to several users, or get to know their product out there and have lower cost of acquisition of their potential customers and provoke leads. So it's a hybrid. It's a very interesting model in the crowdfunding when you can get value plus capital, and the value is that you're bringing in potentially a new client to your environment, right? So basically that's how we work.
Perfect. Well, thank you both, gentlemen, and also for our audience. If you are looking to invest in the Latin and South America market, I would definitely say follow these two gentlemen and continue to follow them on LATOKEN and VCTV. Thanks again to our friends at VCTV and LATOKEN for the opportunity. We look forward to speaking to you guys again. Thanks, everyone.